Hey everyone! Welcome back to Financial Futures, where we break down the latest financial updates and news to help you make informed decisions. In today's video, we're talking about a potential $652 extra per month for Social Security beneficiaries. This includes retirement, disability, SSDI survivors, spousal, and SSI benefits. I've got all the details you need to know right here, so let's dive into what's going on. But first, I just want to take a moment to thank all of you for liking this video and sharing it. And if you're new here or haven't yet, please be sure to subscribe with that button right down below. I post updates every day, keeping you in the loop with all the changes that matter most. Thanks for being here and supporting the channel. Alright. Let's talk about that $652 per month. I know it sounds a bit crazy, right? But new reports show that if certain changes had been made over the past few decades, you could be receiving an extra $652 every month. Yeah, you heard that right, monthly, not annually. So let's break this down because it's important to understand why this isn't currently in your check, but why it should be. So here's the situation. This all comes down to cost of living adjustments, COLA. I know many of us have a love-hate relationship with COLA. We love that it gives us a raise each year, but let's be honest, it's never enough to keep up with rising expenses, right? If we look back about 25 years, since the year 2000, benefits have increased about 81%. Sounds decent, right? But now, here's the kicker: during that same time, expenses have increased by almost 145%. That's nearly double the rate of increase compared to our benefits. The problem here is that the formula used to calculate COLA is outdated. Right now, it's based on something called CPIW, which is the Consumer Price Index for urban wage earners and clerical workers. But here's the thing: most of us receiving Social Security benefits aren't exactly urban wage earners anymore, right? Instead, they should be using CPIE, the Consumer Price Index for the elderly. This would take into account the real expenses that seniors and those on fixed incomes face, like rising healthcare costs, housing, and even food. If CPIE had been used all along, your checks today could be $652 higher per month. Imagine that, an extra $7,800 per year. Think about the difference that could make in your life right now. $652 extra a month? That's life-changing for many people. And the reason this could happen is because of something called compounding. If your COLA had been more accurately reflecting real expenses over the years, that small difference would have compounded year after year. Let's say your monthly benefit is $1,100. If you had a proper 10% increase based on accurate inflation data, that amount would keep growing, compounding every year. After just a few years, your monthly check could have been significantly larger, all because of accurate cost of living adjustments. Now, I know you're probably asking, can this still change? The answer is yes, but it requires serious legislative reform. Advocating for CPIE is one way to make sure Social Security better reflects the needs of retirees and those on fixed incomes. There are groups pushing for this change, but it's going to take more awareness and political pressure to make it happen. Let's jump into our second topic: insurance premiums. If our country didn't have enough challenges already, here's another one coming our way. Insurance premiums are about to skyrocket nationwide, and it's not just about hurricanes hitting coastal areas. The aftermath of Hurricanes Milton and Helene is going to affect us all, whether you live in a disaster-prone area or not. Now, you might be asking yourself, I don't live near the coast or in a flood zone, so why are my insurance premiums going up? Well, that's a good question, but the reality is a bit more complex. The truth is, insurance companies are in the business of protecting their profits. With natural disasters becoming more frequent and severe, they're going to raise premiums across the board. And it's not just in flood or hurricane-prone areas this affects everyone. Let's start with Hurricane Helene. This storm didn't just ravage Florida, it also caused massive damage in Georgia, South Carolina, North Carolina, Tennessee, and Virginia. The worst part? Some of the most devastating damage occurred inland, far from the coast, in places like Asheville, North Carolina. Rivers overflowed, and entire towns were flooded, proving that no one is really safe from these types of storms. And that's just the flooding. Helene also spun off 33 tornadoes, leaving even more destruction in its wake. According to CoreLogic, Hurricane Helene alone caused nearly $48 billion in property damage across 16 states. ACU Weather estimates that the total damage, when you factor in business disruptions, medical emergencies, power outages, and long-term losses to tourism, could be up to $250 billion. But that's not all. Hurricanes Debby, Beryl, Francine, and others this year have collectively caused billions in property damage. And as of today, Hurricane Milton is barreling toward Tampa, with projections of massive damage, though we won't know the full extent until it makes landfall. Now, what does this mean for us? Well, according to S&P Global, many of the largest U.S. home insurers have raised their premiums by 15 to 20% just this year alone. So as natural disasters increase in both frequency and intensity, insurance companies are paying out more claims, and in order to stay profitable, they raise our premiums. And here's something a lot of people don't know: even insurance companies have insurance. It's called reinsurance. And guess what? Reinsurance companies are raising their rates too, which means insurance companies are passing those costs down to us. So not only are premiums going up, but coverage is also shrinking. You've probably heard those horror stories: people think they're fully covered, only to find out after a disaster that their claim is denied, or that their coverage didn't include certain types of damage. Well, that's becoming more common. And if insurance companies can't stay profitable in a certain area, they're just pulling out entirely. Look at this. Farmers Insurance pulled out of Florida entirely in 2023, and Progressive isn't renewing around 100,000 policies to manage their exposure. It's leaving a lot of people in a dangerous position: either pay sky-high premiums or risk having no insurance at all. This is the reality we're facing, and it's not just a Florida problem. The Southeast has been hit hard, and it's spreading. The climate is changing, that's a fact, whether you believe it's human-caused or not. As the climate shifts, we're going to see more natural disasters, which means more claims, and unfortunately, higher premiums. So here's the bottom line: over the next few years, don't expect your insurance premiums to go down. In fact, they're only going to go up. It's a tough pill to swallow, but being informed and prepared is the best thing we can do. I want to thank you for watching and remind you to stay safe in the coming days, especially with storms like Hurricane Milton on the way. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more updates on how to protect your financial future.